This week we have been talking about the analysis of financial statements, and so we're going to go over some of the examples that will be similar to what you're doing on your homework. So the first one is computing and analyzing trend percents. Compute the trend percents for the above accounts using 2015 as the base year. To figure out for 2019 for the trend percent for net sales, you would just take the 2019 sales divided by 2015. We divide by 2015 because that is going to be the base year that we're going to compare each one of these to. And so we just substitute, comes out like that, 189%. And we just do the same thing. So 2018, we take 2018 sales divided by 2015 sales. Same thing, substitute. So 270,800 divided by 150,000 is 181. Okay. And so on and so forth. So then to figure out the trend percent for the cost of goods sold, you would do very much the same thing, but this time instead of using a number for sales, you're going to use the number for the cost of goods sold. So the 2019 cost of goods sold divided by the 2015 cost of goods sold. So we substitute. So 128,200 divided by 67,000 is 191%. So we do the same thing. So 2018, we take 2018 cost of goods sold divided by 2015 cost of goods sold. 122,080 divided by 67,000 is 182%, and you just do the same thing then for each year. So again, you just go up here, we're looking at cost of goods sold, so the year that you're interested in divided by the base year. And then we'll do the same thing for accounts receivable. So we look here, this is accounts receivable, base year was 9,000 for 15. So to do the first one would be the 2019 accounts receivable divided by the 2015 accounts receivable, which is 18,100 divided by 9,000 is 201%. And then 2018, so 2018 accounts receivable, which is 17,300 divided by 9,000 is 192%. You can just keep going. So what this shows you is it shows you the amount of either the increase or the decrease over the base year. And so this allows you to compare things across time. Okay. And so you see here 100% means it's going to be the same. 200% is going to be double, and so on and so forth. Is computing and interpreting the common size percent. Express the following comparative income statement in common sized percents. Using the common sized percents, which item is most responsible for the decline of net income? So again, we're going to look at the current year would be considered 100% for sales, and then everything else would be a percentage of sales. So the current year cost of goods sold, we would take 560,300 divided by 740,000 is going to be 75.7% of the cost of goods sold as a percentage of sales. Gross profit would be 179,700 divided by 740,000 is 24.3%. Current year operating expense would be 128,200 again divided by 740,000 is 17.3. And then the current year net income, 51,500 divided by 740,000 is 7%. Then we can do the same thing then for the prior year. So again, prior year sales would be the 625,000. So again, that would be 100% for that year. And then you can do the same thing. So same thing, cost of goods sold for the prior year was 290,800 divided by 625,000 is 46.5%. The prior year gross profit is 334,200, same thing. And then they want to know what item was most responsible for the decline of net income. And so we see that in the current year, it would be the cost of goods sold increased dramatically in terms of as a percentage. So that's why there was such a decrease in net income. Because we see that in the current year, 75.7% of our sales were taken up by the cost of goods sold, but we see that in the prior year, only 46.5% were. So that's what dropped our net income down. So the current year, we only had 7% net income, but in the prior year, we had 18.5. At the income effects from common size and trend percents. So common size and trend percents for Rusty Nail Company's sales, cost of goods sold, and expenses follow. Determine whether net income increased, decreased, or remained unchanged in the 3-year period. You can take the percents, and then if you have the base year, you can then figure out. So 2018 sales, to figure that out, would be 100,000 multiplied by 104.2%. That would be the trend percent. So trend percent is over time. So we know that it in 18 sales would have been 104,200. And then cost of goods sold for 2018, you would take the base, which is 2017, so 59,100, multiply that by the trend percent in 18, which is 107.7%. That's going to give you the amount of cost of goods sold for 18, 64,478. Same thing here with the total expenses. So we have in the base year was 15,100, multiply that by 98.1, because that's what the percentage was for 18. That's going to give you the amount. And then we can just calculate then what the net income is. Just take the sales minus the cost of goods sold minus total expenses. It's going to give you your net income. And then you can do the exact same thing for 19, but this time using the trend percentages for 19. And then they're asking, determine whether net income increased, decreased, or stayed the same in this 3-year period. Well, it looks like it is decreasing a little bit each year. And our cost of goods sold are increasing each year, and as are our total expenses are increasing. And our sales, they are too, but they're not enough to make up for the increase in our costs. Another example for common size percents. This time it will be how we can do that for the balance sheet. And so remember that the total assets is going to be 100%. And then when we get there, our total liabilities and equities are going to be 100%. So then you're going to take and figure out then what percentage it is of the total. So for example, we see that the first one is cash for 2 years ago is 10% of our total, right? So 27,800 divide, so 37,800 divided by 377,500, that's going to give you 10%. You could do the same thing then for the accounts receivable, 50,200 divided by 377,500 is going to give you 13.3. And you can just do the same thing then for each of these. But if you add these up, they should equal out to 100. And you can do the same thing then for our liabilities and equity. Again, total liabilities and equity is going to be 100%. So then you take the accounts payable, 51,250, take that divided by your total, which is 377,500. That's going to give you 13.6%. Same thing for long-term notes payable secured by mortgage and plant assets, the same thing. Again, these should equal out to 100. Also notice, again, we remember this from way back in like chapter 1 or 2. We remember that our assets, the total amount of assets is going to equal the same as our total amount of liability and equity. Okay, and so you can just go ahead. I'm not going to walk you through it, but you can do the same thing then for 1 year ago and for the current year. So that's all you do just the exact same thing. Then what you can do, now that you have your common size, you can go ahead and just plug those into the comparative balance sheet, which gives you the percentages. And then this makes it really easy. You can look at this and you can see, oh, wow, my amount of cash, it's decreasing. My accounts receivable, it's increasing. So there's something wrong there with that. So we have a accounts receivable that people owe us money, but so our cash is decreasing. Merchandise inventory, that's increasing. Prepaid expenses, that's similar for current year and the previous. And in plant assets, we see that that's decreasing, and accounts payables increasing quite a lot each year. The long-term notes payable, that's staying, went down from the previous year. Your common stock, that's decreasing, and your retained earnings is increasing. So you could use this to figure out trends, and then maybe figure out, okay, I gotta make some changes here as we're going along. How to do the current and asset test ratios. So Simon Company's year-end balance sheet follows. Compute the current ratio and the asset test ratio for each of the following 3 years. And so they give you the comparative balance sheet. And so remember that the asset test is going to be the total of your current liabilities divided by the total of your, current assets, total current assets divided by the total current liabilities. So the current assets would be cash, accounts receivable net, merchandise, inventory, and prepaid expenses. So those would be things that you could turn into cash fairly quickly within a period of one year or less. So we take the total for that, and again for the current year is $244,500. Then our current liabilities, and the only current liability that we have is our accounts payable, which is for the current year is $129,900. So we take that. If we divide that out, we have 1.88%. And you could do the same thing for 1 year. So you add up again your current assets, which again are the cash, the accounts receivable, merchandise inventory, and prepaid expenses. Add those up, you come out with 190,000, and then the total current liability again is only our accounts payable, which is 75,250. You take that, divide it up as 2.53, and then you do the same thing for just using the numbers then for 2 years ago. And so we see here that our liabilities, that they're increasing, and again the amount of assets we have over our liabilities, it's becoming a problem. So our liabilities each year are increasing, our assets are as well, but again, you can see the ratio of it. We're still probably in good shape here, but eventually you're gonna start having problems if the trend continues. That first one was the current ratio. So this is the current ratio. The next one will be the quick ratio, which is quick current assets over total current liabilities. So in this case, quick current assets are just our cash and our accounts receivable net. And then current liabilities is the accounts payable. So we add up. So for the current year, we add up our quick assets, which is the cash and the accounts receivable net. Add those up, come to 121,300, and then our total current liabilities is 129,900. So that comes out to 0.93. Then we could do the same thing for a year ago. We add up for a year ago cash and the accounts receivable, comes out to 98,125 divided by the accounts payable, 75,250. Then we see here, and again, our quick assets are those that would be used pretty much to pay the accounts payable. And we see that it's decreasing. We also see now in the current year it's less than 1. So we know that we need to maybe make some adjustments here because we might eventually run into some problems. Computing your days sales uncollected, the accounts receivable turnover, the inventory turnover, and days sales and inventory. We'll look at those key metrics. So Simon Company's end of year balance sheets follow. The company's income statement for 1 year and for the current year and the prior year ago follow. Assume that all sales are on credit. So we can compute the days sales uncollected, and for this we'll use 365. And so to figure that out would be the accounts receivable divided by the net sales multiplied by 365. And so for that, we have the accounts receivable. We could get that from the balance sheet current is 89,500. And then we look at the net sales, which is from the income statement. Sales for the current year is 673,500. So we would divide this, multiply by 360. We're going to come out with 48.5 days for the current year. And then you do the same thing for 1 year ago. So 1 year ago, we look at that. We go down here to the accounts receivable is 62,500. And then we look at the net sales for a year ago is 532,000. So we divide this, multiplied by 365 is 42.9. So we see here now that in the current year that it's taking a little bit longer for us to get collected from our sales. So now we'll look at the accounts receivable turnover. Accounts receivable turnover is the net sales divided by the average of the accounts receivable. And so the first, for the current year, we again look at our net sales at 673,500. And then we take, to figure out our average of the accounts receivable, you're going to take the current year and then the plus the year previous, and then you'll add that together, divide by 2. So we would take 673,500 divided by 76,000. It's going to be 8.9 times. And then for a year ago, if we look, our net sales is 532,000 divided by 62,500 plus the 50,200. So you're going to do year ago and then the year previous to that to get the average divided by 2. So it'd be 532,000 divided by 56,350 is going to be 9.4 times. So again, we see here that the accounts receivable, we're starting to slow down a little bit on our collections for our accounts receivable. And in our cost of goods sold, we can determine that by taking our cost of or the inventory turnover. So to do inventory turnover, we take the cost of goods sold, which is 411,225. We just take that right from the income statement for the current year. And then we take the average inventory. We get that by looking at the merchandise inventory, very similar to what we did before, current year and the year previous. So 112,500 plus 82,500. You add both those up, divide that by 2. So you would then have 411,225 divided by 97,500. So our inventory turnover is going to be 4.2 times. And then we can do the same thing for year 1. So our cost of goods sold in the previous year ago is 345,500. And then you take that to figure out the average inventory. You're going to take the year ago, 82,500, plus the 54,000 from the year previous to that. Add those up, divide by 2. So you're going to come out with 345,500 divided by 68,250 is 5.1 times. So what we see here is the fact that we're also then not turning over our inventory quite as fast during the year. And then to figure out the days sales inventory, you're going to take the ending inventory divided by the cost of goods sold multiplied by 365. So our ending inventory for the current year is 112,500 divided by the cost of goods sold, which we would get that from the income statement. Cost of goods sold 411,000 225 multiplied by 365, you're going to come out with 99.9 days of inventory. And then you could do the same thing for a year ago. So you take the merchandise inventory ending, 82,500 divided by the cost of goods sold of 345,500, we get 87.2 days. So again, we see that the merchandise is staying in our inventory a lot longer, a little over 3 months worth, because 90 days is about 3 months. At the risk and capital structure, and so the for that, the ratios for that would be the debt ratio, the equity ratio, and the debt to equity ratio. So Simon Company's year-end balance sheets follow. The company's income statements for the current year and 1 year ago also follow. Assume that all sales are on credit. And so we'll calculate the company's long-term risk and capital structure positions at the end of each year by computing the following ratios, which is our debt to equity ratio, an equity ratio, and a debt to equity ratio. So the first one is our debt and equity ratios. So our debt ratio is total debt divided by total assets. And so for that, to figure out the total debt, you're going to take would be the accounts payable and the long-term notes payable. That's debt, and then total assets would just be the total for the assets. So total debt is 200 for the current year is 228,400 divided by total assets, which is 523,000. So then our ratio is 43.7%. And then same thing for the current year. If you look, total debt again, 75,250 and 101,500. Add those up, comes out to 176,750. That's our total debt divided by the total assets. And if we look, total assets for a year ago is 445,000. So divide that out, is 39.7% is a debt ratio. Then our equity ratio is going to be then our total equity divided by our total assets. So total equity, to figure that out for a year ago, our equity is our common stock at $10 par value, 163,500, and our retained earnings 131,100. We add up both of those, we come out with 294,600, and then we divide that by the total assets for that current year, which is 523,000. We come out with 56.3%, and we do the same thing for a year ago. So we take again our total equity, which is our common stock, 163,500, and then our retained earnings 104,750. Add those up, comes out to 268,250 divided by our total assets for a year ago, which is 445,000. It's going to come out with 60.3%. So we see that we're taking on more debt than we had a year ago, and our equity is decreased from where it was a year ago. So then our debt to equity ratio. So we see, again, these are our debt ratios and our equity ratios. And so we notice that the sum of these equals 100%, which makes sense, but that's one way you can check. And so your debt to equity ratio then is your total debt divided by the total equity. So again, total debt for the current year is going to be your accounts payable and your long-term notes payable secured by mortgages on plant assets. Total is 228,400 divided by total equity, which is the common stock, $10 par, 163,500, and your retained earnings 131,100. So you add both of those up, that's your total equity. This comes out to 77.5% or 0.78 to 1. And you can do the same thing for the prior year. You add up your debt, 75,250 is accounts payable, and then the long-term notes payable secured by notes for on plant assets, 101,500. Add both of those up. It's 176,750 divided by the total equity, which again is your common stock at $10 par value and the retained earnings. So 163,500 plus 104,750 is 176,750 divided by the total equity. Again, add those up, you get 268,250. So it's 65.9% or 66 0.66 of 1%. And then we can figure out our times interest earned. And so it would be the income before interest and taxes divided by the interest expense. And so the income before interest, if we look over here, the income statement is, you could figure that out by taking the sales and then subtracting out the cost of goods sold and the other operating. That leaves 52,725 divided by the interest expense, which is 12,100. So that's going to give you 4.4 times. And you can do the same thing for the previous year, is to figure out the income before interest and taxes. You're going to take your total sales and you're going to subtract from that the cost of goods sold and the other operating expenses. That's going to leave 51,520, and then divided by the interest expense, which is 13,300. That's going to be 3.4 times. The efficiency and profitability, which are the profit margin ratio, the total asset turnover, and the return on total assets. Simon Company's year-end balance sheets follow. The company's income statements for the current year and 1 year ago follow. Assume that all sales were done on credit. So we'll evaluate the company's efficiency and profitability by calculating the following each year. So we'll calculate the profit margin ratio, the total asset turnover, the return on total assets. So the first one we'll do is the profit margin ratio. And so to calculate that is going to be the net income divided by net sales. So if we look over here on the income statement for the current year, our net income, we can just take that right off of the statement. It's 31,100. We'll divide that by the sales, which again, you can just read right off of the statement, which is 673,500. So you take that, divide it, comes out to 4.6%. Then we can do the same thing for a year ago. We take the net income for a year ago, which is 29,370, divide that by the net sales, which are 532,000, comes out with a profit margin of 5.5. And again, we see here now the profit margin is decreasing from the current year versus where we were just 1 year ago. Now we can look at computing the total asset turnover. And to do that, you're going to take net sales divided by the average of your total assets. So the net sales, again, you can just read that right off of the income statement for the current year is 673,500. And then to figure out the average sales or average total assets, if you look, you have the total assets. So it would be 445,000, and then from the previous year, and then plus the current year, which is 523,000. You take the sum of that, divide that sum by 2. You come out with 484,000. So we take our net sales, 673,500, divided by the average of the total assets, comes out to 1.4 times. And then we can do the same thing for a year ago. So again, we look, our net sales are 532,000 from a year ago. And in our total assets, we take 2 years ago and then a year ago, add those up, divide them by 2. We come out with 411,250. So we take 532,000 divided by 411,250. We come out with 1.3 times. And then a return on total assets is going to be our net income divided by the average total assets. So same thing. The net income, we can just again read that right off of the income statement for the current year is 31,100, and then we can divide that by the average of the total assets again. So you look at a year ago versus the current year, add those up, divide that by 2, you come out with 484,000. So you take 31,100 divided by 484,000. So the return on total assets is 6.4%. And then again, a year ago, same thing. So net income is 29,375, and then divide that by the total assets from a year ago and then 2 years ago, add them up, divide them by 2. So 377,500, that's the previous year, 2 years ago, and then a year ago was 445,000. Take that, add it up, divide it by 2, you're going to come out with 411,250. So 29,375 divided by 411,250 is 7.1%. Different ways that you can figure out for profitability. And so to measure profitability, you can use the return on common shareholders' equity, and you can also use your price earnings ratio. So we'll take a look at those. So same thing again is Simon Company's year-end balance sheet follows the company's income statement for the current year and 1 year ago also follow. Assume that all sales are on credit. And so additional information about the company follows. So common stock market price on December 31st of the current year is $30, and then the common stock market price for this on December 31 of 1 year ago is $28. To help evaluate the company's profitability, compute the following ratios for each year: is return on common stockholders' equity and the price earnings ratio. So the first one that we will do is we'll look at the return on common stockholders' equity. And so for that is going to be the net income minus the preferred dividends divided by the average stockholders' equity. To calculate this on this one, they don't have any preferred dividends. Okay, so otherwise they would have to tell us that. They don't. So you're just going to take the net income, which we can just pull right off of the income statement, is 31,100. Divide that by the average of the shareholders' equity. So if you look over here on the balance sheet, the shareholders' equity would be the common stock at $10 par value, and then also the retained earnings. So you would take both of those, add them up, divide them by 2. So again, it would be for, in the case, if we're figuring out for the current year, it would be the current year and 1 year ago. So we come out to 281,425. And then again, the net income of 31,100. So we take 31,100 divided by 281,425. So the return on common stockholders' equity is 11.1%. And then we could do that same thing for a year ago, is we just look, we take the net income, which is 29,375, and then same thing. So we take the total for the year ago for the shareholders' equity, stockholders' equity, we add those up, then we take the 2 years ago, same thing, add them up, divide by 2, we come out to 255,500. So we take 29,375 divided by 255,500, we come out with 11.5%. And then to calculate the price earnings ratio is going to be the market price per common share divided by the earnings per share. And so they give you the earnings per share and they give you the common stock price, market price for the current year end. Now, if you didn't have that offhand, you could look at Yahoo, or you could look at some different places. You can look back and find the historical stock price for each share of company stock. If it's a publicly traded company, you can look that up. Okay. Otherwise, you would have that. So we know then that for the current year is $30 is the common stock market price at the year end, divided by the earnings per share, which is $1.90. So that comes out to 15.8. And you could do the same thing for 1 year ago. We know that the common stock market price was $28, divided by the earnings per share from a year ago is $1.80. Comes out to 15.6. We can also calculate our dividend yield. And so annual cash dividends per share divided by the market price per share. And they give us that broken down per share. The current year we look is 29 cents is the annual cash dividend that was paid per share, divided by the stock price, which for the current year was 30, is going to be 1.0%. And then for a year ago, the annual cash dividends for the prior year was 24 cents. And then take that divided by the cost, the market price per share of $28 is 0.9%. Doing the categories for our income statement and figuring out the different categories that how we would categorize these. So in the current year, Random Merchandising Incorporated sold its interest in a chain of wholesale outlets, taking the company completely out of the wholesaling business. So they were doing one thing, they've decided that they no longer want to do wholesaling. So they've sold all interest in the chain of wholesale outlets, and they stopped doing that. The company still operates their retail outlets. A listing of major sections of the income statement follows. So we have those. And so we're going to indicate whether each of the following income-related items for the company appears on its income statement by writing the letter of the appropriate section on the blank beside each item. And so the first one is going to be the net sales less operating expense section. The first major section shows the revenues and expenses from the continuing operations. Users especially rely upon this information to predict future operations because that's what the company still is going to continue to do. And so in this case, it would be anything dealing with the retail, because they're going to continue to have their retail operation. They're going to cease doing their wholesale operation. So that would be what A would be. Now B would be other unusual or infrequent gains or losses are reported separately as a component of income from continuing operations before tax. So, and I already see what these are going to be, but it would be something that happens, but it's infrequent, it's unusual, but it has to do with something that affects their current operation, but it's not part of their current operation. We'll figure out what examples of what those would be in just a minute. Then the taxes reported on income or loss from continuing operations is the income tax effect of net sales less operating expenses and any unusual or infrequent items, and is reported immediately before income from continuing operations. And then D is our discontinued operations, is the company's gain or loss from selling or closing down a segment. It is separately reported. Discontinued operations report both the income from operating the discontinued segment for the current period prior to its disposal. So let's say that they quit in June, the wholesaling. Well, they still would have January through May that they would still have to deal with. But then after that, they quit doing it. And also the loss from disposing of the segment's net assets. These items would be reported net of tax. So we see that our net sales, that would be part of our net sales less operating expenses section. That's where that would go. Then we see that the gain on the state's condemnation of company property. So the state came in, they condemned the company's property, and then the company then sold the property as is. They was a gain of $230,000. That would be another unusual or infrequent gain or loss. In this case, it was a gain because it's not part of our business. We're not in the business of selling property. We're in the business of selling retail, having a retail store and having retail products. But this was a gain that happened. We have to record that. So that would be part of B. And then the cost of goods sold, that would be part of our net sales less operating expense section, because that is going to be an operating expense because we sell products. So we have a cost of goods sold. Our income tax expense would be taxes reported on the income or loss from continuing operations. So that would be a C. Our depreciation expense, that would be A. That would be part of our continuing operations. Net sales less operating expense section would be where our depreciation would go. Gain on sale of wholesale business segment net of tax, $775,000. Well, that would be D. That would be part of a gain from discontinued operations. and then a loss from operating wholesale business segment. So they operated it for part of the year and they actually lost money. So that would also then be considered D, which is income or loss from operating or gain or loss from disposing a discontinued segment. So they've sold off that part of the business. And then 8 would be considered B, which is an other unusual or infrequent gain or loss, is a loss on assets from meteor strike. So they had a meteor that struck their building and caused damage to their building. That cost them $640,000. That would be considered another unusual and frequent. So a meteor strike, the wildfires that we've experienced in the area, a flood, the coronavirus, anything like that would be considered an act of God. And so that would be considered an unusual or an infrequent gain or loss. This would be usually a loss would be associated with that. But it's unusual. It's not something that happens all the time. We can't predict it, but sometimes we have to deal with that. Income statement preparation. So in the current year, Random Merchandising Inc. sold its interest in a chain of wholesale outlets, taking the company completely out of the wholesaling business. The company still operates its retail outlets, and so will prepare its income statement. Again, you'd set up your heading. So the name of the company, which is Random Merchandising Inc., and this is our income statement for the year ended on December 31st. So we have net sales of $2,900,000, and then we have our expenses. So our expenses are the cost of goods sold, depreciation expense, and our total. So we add those up, get our total operating expense. And then we have other unusual or infrequent gains or losses. So we had the gain on the state's condemnation of business property, which is $230,000. Then we had a loss of assets from a meteor strike. Again, a loss or a negative number is going to be in parentheses, $640,000. So income from continuing operations before tax would be, so we take this number right here, $1,188,000. We take that, we add the gain from the condemnation of property, we subtract the loss in the meteor strike, we come out with $778,000, and then we have income tax expense of $217,000, and then we have our income from continuing operation of $561,000. Then we have our loss from the discontinued segment, wholesale segment of $444,000. Then we have the gain of sale of the wholesale business segment, net of tax is $775,000. So we take that. So we take the gain, subtract the loss from that. We come out with $331,000. So we take that, subtract that from the income from continuing operations, or we add that to, because it's a positive number, we add that to the income from continuing operations of $561,000. We come out with our net income, or our bottom line profit then, of $892,000 for the year ended of December 31st.